100 hours. That's how much time the average SMSF trustee spends running their own super fund every year. So when someone says you should run your own super fund, the real question is not just control. It's whether your household wants a second admin job attached to your retirement money. By the end of this, you'll have a simple two-question test. What can an SMSF do that your current fund cannot, and what are you paying in dollars, time, and exit risk to get it? We ran that comparison on our own super before we let ourselves have an opinion. That matters because an SMSF can be a genuinely powerful tool, but it is not just the upgraded version of a normal fund. It is a different job with different costs, different duties, and much less room to drift. Quick note before we go further, this is general information, not advice for your situation. Every household's super, balance, and goals are different. Control feels productive. You can see the bank account, the shares, the paperwork all in one place. For anyone who likes things tidy, that idea is genuinely appealing. There's also a quieter worry underneath it, the feeling that everyone else is somehow getting ahead while you sit in a default fund doing nothing. That worry is exactly what sales conversations lean on. Then a friend mentions they run their own super now, and suddenly it feels like something you're missing out on. Which raises the obvious question, is this actually a smart move or a sales pitch dressed up as advice? Here's the part that changes everything. A normal super fund runs the whole machine behind the scenes, the paperwork, the compliance, the reporting. An SMSF moves all of that machinery onto you. It isn't just a cheaper brokerage account sitting inside super. It's a regulated retirement structure, and you become legally responsible for running it properly, even with professionals helping. The fund exists for one job, funding your retirement, not paying for life right now. That single rule is the filter that quietly disqualifies a lot of SMSF ideas before they even start. It's also not a one-person structure by default. Up to 6 people, a partner, family members, can join the same fund, which means the paperwork load can be shared, but so can the blame if something's missed. So when does taking on all of that actually make sense? There are really 4 situations where an SMSF earns its keep, and each one comes with its own catch. The first is wanting direct control, picking specific shares, term deposits, or funds instead of a fixed menu. It feels like finally being the one steering, not just picking from a list. The catch is that every investment still has to fit your fund's written strategy and super law, not just whatever looks exciting that week. Chasing a hot tip is not an investment strategy. Direct control feels exciting precisely because you can concentrate on what you believe in, but the fund still needs to survive if one of those bets doesn't work out the way you hoped. The second is business owners wanting their fund to hold the premises their business leases, shop, warehouse, office. Done properly, that can genuinely make sense. The hurdle is that related party rules, valuations, and borrowing limits are strict. Treat it like your personal asset instead of the fund's, and a sensible plan turns into a compliance problem fast. The third is wanting more control closer to retirement, pension payments, asset sales, and who inherits what. This is where custom planning starts to genuinely earn its cost. The hurdle is that super, tax, and family relationships overlap here, and mistakes are expensive to undo. This is a moment for real professional advice, not a weekend research project. The fourth situation is a mindset, not an asset. Trustees who document decisions, check liquidity, and separate personal money from fund money. Confidence alone doesn't do that job. This decision also feels different depending on where you sit. A renter building flexibility, a homeowner with equity, a regional household further from services, the same SMSF question lands differently for each. It shifts again with life stage 2. A single-income household often has less room for extra admin, a young family has less spare time, and someone closer to retirement usually has both a bigger balance and more reason to want control. And within a household, it matters too. If one partner gets sick, moves overseas, or simply loses interest, somebody still has to keep running the fund. Engaged trustees on both sides matters as much as the balance. So pause on this for a second. In your household, is the appeal really about a specific investment you can't access any other way, or is it mostly the feeling of wanting more control? Now for the part sales conversations tend to skip, the actual math, and where this quietly goes wrong for a lot of households. Every year, an independent auditor checks the fund's records, valuations, and compliance, not as a formality, but because trustees are personally on the hook if something in that stack doesn't hold up. Picture a fund holding $200,000. A typical yearly running cost there can quietly eat around 2.5% of the whole balance every single year. Now picture $1,500,000. The same rough dollar cost barely registers, closer to 0.3% of the balance. Same fee, completely different impact. There's no official minimum balance that makes an SMSF right or wrong. But that's exactly why the fixed cost math matters more than any rule of thumb you'll hear secondhand. And that 100 hours from the start isn't a scare tactic. It's meetings, valuations, records, and an annual audit, on top of everything else life already asks of you. Another red flag is putting almost everything into one asset, one property, one big holding. If that single asset struggles, there's nothing else in the fund to soften the fall. Rolling every dollar out of an old fund can quietly cancel life or income protection cover that fund was carrying, cover that's easy to forget about until it's already gone. Planning an extended trip overseas or a move for work also deserves a second look. SMSF residency rules can trigger serious tax consequences if nobody checks them first. And the biggest flag of all, anyone linking an SMSF setup to a specific investment they're also selling you. A genuine review found real problems hiding in exactly that kind of advice. So here's the practical filter. Question 1, written down, no rushing. What exact benefit does an SMSF give us that our current fund genuinely cannot? Question 2, what dollar cost, time cost, and exit cost are we accepting to get that benefit? If either answer feels blurry, the case isn't ready yet. Before talking to any SMSF provider, write a one-page comparison instead. Admin cost, investment control, insurance, and compliance work side by side. Ask for that advice in writing. Then test the exit plan specifically. What happens if a member dies, separates, moves overseas, loses interest, or the main asset has to be sold? A good plan makes that manageable, not messy. The right mindset here was never we can do anything with our own fund. It's we can only do what the fund legally allows. For retirement, with records an auditor can actually follow. If this helped map your thinking, subscribe. We run the numbers on one Australian money question every week.